Alright, let's get straight to it. Before we dive in, please remember that this video is for informational and educational purposes only. I am not a financial advisor, and this presentation does not constitute financial, legal, or investment advice. The cryptocurrency market is highly volatile and carries significant risks. You should always conduct your own thorough research and consult with a qualified professional before making any investment decisions. Your capital is at risk. You see the headlines everywhere. Bitcoin just shattered its previous record. Some cartoon dog coin is up 50,000%. Your cousin, who you haven't spoken to in 5 years, just paid off his car with something called an altcoin. You feel that pull, that little voice in your head saying, I need to get in on this. So you do what everyone does. You pull out your phone, you open the app store, you type in crypto, and suddenly, you're staring at a wall of logos. Dozens of them, all screaming for your attention. Blue ones, purple ones with rocket ships and animal faces. They all promise the same thing. The future of finance. Buy Bitcoin in seconds. Your journey to Web3 starts here. But which one is real? Which one is a scam? Which one is going to take your hard-earned $100 and turn it into 85 before you even buy anything thanks to hidden fees? This is the single biggest barrier for millions of Americans who want to invest in crypto. It's not understanding the blockchain. It's not trying to figure out what a Dogecoin is. It's the paralyzing fear of choosing the wrong door to walk through. Because let me tell you something most people don't realize. The app you choose can be more important than the coins you buy. Choosing the wrong app can mean paying thousands of dollars in unnecessary fees over your lifetime. It can mean your assets are locked when you need them most during a market crash. And in the worst-case scenario, it can mean losing everything. That is the problem we are going to solve right here, right now. Over this series, we are going to create the ultimate no-nonsense guide to the most popular crypto investing apps available in the United States. We're going to tear them apart piece by piece. We're talking about Coinbase, Kraken, Gemini, Binance US, Robinhood, Crypto.com, and more. We'll look at their fees, the real fees, not the ones they advertise. We'll look at their security, their coin selection, their customer support, and most importantly, who each app is actually built for. By the end of this, you will know with 100% confidence which platform is the perfect fit for you, for your goals, and for your money. How do we do that? Because I've spent hundreds of hours and used my own money to test every single one of these platforms. I've been the beginner who paid the ridiculously high fees. I've been the intermediate trader who got frustrated with a clunky interface. I've read the terms of service so you don't have to. This isn't theory. This is a battle-tested roadmap from the trenches. So let's start where most Americans start. The giants. The household names. The apps that spend millions on Super Bowl commercials. We're talking about the beginner-friendly category, and the undisputed king of this category is Coinbase. If you've heard of one crypto app, it's probably Coinbase. They are a publicly traded company on the NASDAQ. They're based in the US. For millions of people, Coinbase is the front door to crypto. And for good reason. Their mission from day one has been to make buying cryptocurrency as easy as buying a stock or ordering a pizza. And they nailed it. The interface is clean, it's simple, it's intuitive. You can link your bank account or debit card and own your first piece of Bitcoin in less than 5 minutes. Feels safe. Feels legitimate. It removes all the scary, complex stuff and just lets you click buy. This ease of use is their superpower. It's why they have over 100 million users. But that simplicity, it comes at a staggering cost. And this is Coinbase's dirty little secret. Their fees are some of the highest in the entire industry. They bank on the fact that you're new, you're excited, and you won't look too closely at the fine print. Let's break it down. When you buy crypto on the main, simple Coinbase app, you're not just paying one fee. You're often paying two. First, there's the spread. This is a little margin they add to the market price of the crypto. So if Bitcoin is trading at exactly $60,000 on the global market, Coinbase might sell it to you for $60,150. That's their built-in profit. It's usually around 0.5%. But that's not all. On top of the spread, they charge a Coinbase fee. This is a transaction fee, and it's a complicated mess. It's the greater of either a flat fee or a variable percentage. For small transactions, the kind most beginners make, the flat fees are brutal. Buying $10 of crypto? That'll be a 99-cent fee. That's a 10% fee right off the top. Buying $50 worth? A $2 fee. $200? A $3 fee. Your investment is in the red before it even has a chance to move. For larger trades over $200, they switch to a variable fee, which is typically 1.49% for using your bank account. If you use a debit card for that instant gratification, it's an eye-watering 3.99%. Think about that. If you invest $1,000 using your debit card, you are instantly losing $40. That's insane. In the stock market, you can trade for free. On Coinbase, you're paying a massive premium for convenience. Now, you might have heard of something called Coinbase Pro, which has now been rebranded and integrated as Coinbase Advanced. This is their platform for more experienced traders, and the fees are dramatically lower, often less than 0.5%. It uses a maker-taker fee model, which is the industry standard. This is the single most important thing to understand about Coinbase. The company essentially runs two different businesses under one roof. There's the simple, beautiful, incredibly expensive app for beginners, and there's the slightly more complex but vastly cheaper, advanced platform for people in the know. They count on new users not knowing the difference, and they make billions from it. So rule number 1 for Coinbase: if you absolutely must use it, learn to use the advanced trading feature immediately. Beyond fees, there's a bigger, more philosophical issue with Coinbase and other centralized exchanges. When you buy Bitcoin on Coinbase, you don't actually hold the Bitcoin. Coinbase holds it for you. You have an IOU from Coinbase for that Bitcoin. You see it in your account, but you don't control the private keys. As the saying goes in crypto, not your keys, not your coins. What does this mean for you? It means you are trusting a third party with your assets. Now, Coinbase is one of the most trusted and regulated players out there. They hold a massive amount of insurance and have a great security track record. But you are still exposed to what we call custodial risk. If Coinbase were to go bankrupt, or if their platform freezes during a massive market crash, you might not be able to access your funds. We saw this with other major exchanges that collapsed, where millions of users lost everything. While it's unlikely with a company like Coinbase, the risk is never zero. It's the fundamental trade-off. You give up some control for convenience. So who is Coinbase for? It's for the absolute beginner. The person who is terrified of the complexity of crypto and just wants the easiest, most frictionless way to buy their first $50 or $100 worth. It's the perfect on-ramp to get started, to get your feet wet, and to understand how it all works. It's a great learning tool, but it is not a place where you should be making large, frequent trades or storing your life savings long-term, unless you're willing to pay that massive convenience tax and accept the custodial risk. Think of it as the tourist trap of crypto exchanges. Easy to find and welcoming, but everything inside is overpriced. Now, Coinbase isn't the only app playing this game of super simple, high-fee access. What about the apps you might already have on your phone like Robinhood or Cash App? They've also jumped headfirst into crypto, promising zero commission trading. But is it really free? And what are the hidden trade-offs you're making when you buy Bitcoin right next to your stocks? That's where things get even more interesting, and it's where we're headed next. So let's pull back the curtain on commission-free. When you place an order to buy Bitcoin on an app like Robinhood, they don't send your order directly to a major exchange like the New York Stock Exchange. Instead, they route it to a third-party firm, what's known as a market maker or a liquidity provider. These firms are massive players who handle huge volumes of trades. They pay Robinhood for the right to execute your trade. This is called payment for order flow, or PFOF. Now, why would they pay for your small $100 Bitcoin purchase? Because they make money on something called the spread. The spread is the tiny difference between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept for an asset at any given moment. These market makers can execute your trade at a slightly better price than you see on your screen and pocket the microscopic difference. It might be fractions of a penny on a single trade, but when you multiply that by millions of trades from millions of users every single day, it adds up to a staggering amount of money. Think of it like a currency exchange booth at the airport. They have a buy price and a sell price for euros. If you want to buy, you pay a higher price. If you want to sell, you get a lower price. The booth makes its profit from that gap in the middle. In essence, while you're not paying a direct line item commission, the cost is baked into the price you get. You might be paying a few cents more for your crypto or receiving a few cents less when you sell. For most small retail investors, this difference is negligible, and they're happy to trade that for the convenience and simple interface. But it's crucial to understand that nothing is ever truly free. The money is being made, you just don't see the transaction on your statement. But the business model is only half the story. The bigger, more philosophical debate with these TradFi, or traditional finance apps moving into crypto is about ownership. And this brings us to one of the most important phrases you will ever hear in the crypto space. Not your keys, not your coins. When you buy crypto on Robinhood, you don't actually hold the crypto yourself. Robinhood holds it for you in a giant commingled wallet. You just have an IOU, a line on your account that says you own 0.1 Bitcoin. For years, this was a massive criticism because you couldn't do anything with it. You couldn't send it to a friend, you couldn't use it to buy something online, and you couldn't move it to a more secure personal wallet. It was stuck in their ecosystem. Your only option was to sell it back for US dollars. Now, to their credit, they have since rolled out the ability to withdraw certain cryptocurrencies to an external wallet, which is a huge step in the right direction. But the default is still custodial, meaning they are the custodian of your assets. You are trusting them to keep it safe. You are trusting them not to go bankrupt. You are trusting them not to freeze your account. For the absolute beginner who is terrified of managing their own security, this might even sound like a good thing. But for anyone who believes in the core crypto ethos of self-sovereignty and decentralization, it's a fundamental deal-breaker. So, who is Robinhood for? It's for the person who already has a Robinhood account for stocks, sees Bitcoin and Dogecoin on the list and thinks, hey, why not throw $50 at it? It's the path of least resistance. The user interface is famously clean, simple, and maybe a little too much like a game. It excels at one thing: removing friction. It makes buying a speculative digital asset feel as easy as ordering a pizza. And for millions, that was the only invitation they needed. But if you get serious, if you want to explore the vast universe of crypto beyond the top 10 coins, or if you want true ownership of your digital assets, you will outgrow it, and you will outgrow it fast. This limitation, this walled garden approach, is the perfect jumping-off point to our next contender, the undisputed heavyweight champion of crypto on-ramps in the United States, Coinbase. If Robinhood was the gateway for stock investors to stumble into crypto, Coinbase was the purpose-built, brightly lit, official front door for the entire country. For many Americans, Coinbase is crypto. It's the brand name they know, the one they see commercials for, and the one that's a publicly traded company on the NASDAQ. That last point is a big deal. Being a publicly traded U.S. company brings a level of regulatory scrutiny and financial transparency that provides a massive sense of security for new users. Feels safer, more legitimate. And when you first download the main Coinbase app, the one with the blue logo, it feels a lot like Robinhood. It's incredibly user-friendly. Big clean buttons. Simple buy and sell options. You link your bank account, and within minutes you can own your first fraction of a Bitcoin. It's designed to be foolproof. But this simplicity comes at a steep price, and I mean that literally. The fees on the standard Coinbase app are among the highest in the industry. Coinbase uses a complex fee structure that combines that spread we talked about, baking a margin of about 0.5% into the price, asterisk plus asterisk a separate Coinbase fee. This fee is the greater of either a flat fee for small transactions, like a few dollars for a $50 purchase, or a variable percentage for larger ones. When you add it all up, you could easily be paying 2 to 4% of your total purchase in fees, which can absolutely crush your returns over time. But here is the secret that Coinbase doesn't exactly advertise on the front page. There is a way to use Coinbase and pay dramatically lower fees. For years, they had a separate platform called Coinbase Pro, which was for active traders. It had more complex charts and order types, but the fees were a fraction of what the main app charged. Recently, they've integrated this functionality into the main app under a section called Advanced Trade. By simply tapping a few extra buttons to access this mode, you switch from the high-fee, simple interface to a low-fee, professional-grade trading platform. The fees here drop from percentages down to as low as 0.6% and get even lower the more you trade. It's the single most important piece of advice for any Coinbase user. Learn to use Advanced Trade. You are accessing the same platform, the same security, the same company, but you're saving yourself a fortune in the long run. Beyond fees, Coinbase's other huge advantage over the TradFi apps is coin selection. Where Robinhood offers a couple dozen of the most popular coins, Coinbase lists hundreds. It's your portal to a much wider crypto ecosystem. You can explore up-and-coming projects, different blockchains, and specialized tokens. It's the next logical step for someone who has bought Bitcoin and Ethereum and now wants to see what else is out there. But even with its massive selection and advanced trading options, the standard Coinbase platform shares that same fundamental characteristic as Robinhood. It's a custodial service. When you buy crypto on Coinbase, they hold it for you. You are trusting them. They have a phenomenal security track record, arguably one of the best in the world, but the principle remains. You are a client of a financial institution, not a sovereign individual holding your own digital wealth. But what if you don't want to trust Coinbase or any company with your money? What if you want to take that final step and truly be your own bank? That's not just a catchy phrase in crypto. It's an achievable reality. And it starts with a different kind of app, a different kind of wallet, one that puts the power and all of the responsibility squarely in your hands. This kind of wallet is called a non-custodial or self-custodial wallet. And the difference is the single most important concept you need to understand in your entire crypto journey. It's the difference between having an IOU for a gold bar in a bank vault versus holding that physical gold bar in your own hand. When you use a centralized exchange like Coinbase or Kraken, they are the custodian. They hold the crypto on your behalf. They manage the complex private keys, and you just have a username and password to access your account. If you forget your password, you can click Forgot Password, answer some security questions, and get back in. It's convenient. It's familiar. But here's the catch. It's not truly yours. It's an entry in their database. You are trusting them to be solvent, to be secure, and to give you access when you ask for it. This is where the famous crypto mantra comes from. Not your keys, not your crypto. A self-custodial wallet flips that entire model on its head. With these apps, you generate and hold the private keys. You and you alone. Think of your crypto wallet as a digital vault. Your public address, the one you give people to send you crypto, is like the mail slot on your vault. Anyone can put things in. But the private key, that is the only key that can open the vault and take things out. It's a long, complex string of letters and numbers that should never, ever be seen by another human being. Now, because memorizing that private key is nearly impossible, the system gives you something much more human-readable. A 12 or 24-word recovery phrase, also called a seed phrase. This phrase is the master key. It's the blueprint that can recreate your private key on any compatible device in the world. If your phone falls into the ocean or your laptop gets fried, you can download a new wallet, enter that secret phrase, and poof. All of your assets are right there, safe and sound. But this is a double-edged sword of immense power and terrifying responsibility. If you lose that seed phrase, your crypto is gone. Forever. There is no forgot password button. There is no customer support line to call. No one can help you. It is the digital equivalent of burying a treasure chest on a deserted island and then burning the only map. Conversely, if anyone else gets their hands on your seed phrase, they have total unrestricted access to your funds. They can drain your wallet in seconds, and there is absolutely nothing you can do to stop them or get it back. So why on earth would anyone take on this risk? Because this is the key that unlocks the real promise of Web3. It's how you interact with decentralized finance, or DeFi, to earn yield. It's how you mint and trade NFTs directly. It's how you participate in decentralized autonomous organizations, or DAOs. It's your passport to the entire crypto ecosystem that exists beyond the simple buy and sell buttons on a centralized exchange. Let's talk about the most popular apps that give you this power. The undisputed king, the one you've probably heard of, is MetaMask. MetaMask is the OG, the gateway for millions of people into the world of Ethereum and any other blockchain that's compatible with it, like Polygon, Avalanche, and Binance Smart Chain. It primarily exists as a browser extension for Chrome, Firefox, or Brave, and also as a mobile app. When you visit a decentralized application, a dApp, in your browser, MetaMask pops up and asks for your permission to connect. It acts as the bridge between you and the application. Imagine you want to buy an NFT on a marketplace like OpenSea. You find one you like, you click buy, and your MetaMask extension will pop up, showing you exactly what you're about to do. Spend this much ETH to receive this specific NFT. You review the transaction, you click confirm, and MetaMask uses your private key, which is stored securely on your device, to sign and authorize that transaction on the blockchain. You never had to give your private key to OpenSea. You just used MetaMask to prove you owned your funds and approve the exchange. That is a revolutionary concept. MetaMask is essential. It's not the most beginner-friendly, and its interface can feel a bit technical, but its ubiquity makes it a must-have. If you want to explore the vast majority of what Web3 has to offer, you will need a MetaMask wallet. Setting one up is free. You download the extension, it guides you through creating a password, and then it reveals your secret 12-word recovery phrase. You write that phrase down on paper, never on a digital device connected to the internet, and you store it in multiple safe physical locations. And you never ever type it into a website or share it with anyone claiming to be support. Next up, let's look at Trust Wallet. As the name implies, it was built with the philosophy of trust and user control. Acquired by the crypto exchange Binance in 2018, it operates as a separate, self-custodial entity. While MetaMask started as a browser extension and then built a mobile app, Trust Wallet was mobile first from the ground up, and it shows. Its interface is generally considered cleaner and more intuitive for beginners than MetaMask's mobile app. Trust Wallet is a multi-chain powerhouse. It supports a staggering number of different blockchains and assets right out of the box, often more than MetaMask without needing to add custom networks manually. It has a built-in dApp browser, so you can access Web3 sites directly from within the app. It also has integrated features for staking certain cryptocurrencies, allowing you to earn rewards on your holdings without having to move them to a complex third-party platform. For many users who do most of their crypto activity on their phone, Trust Wallet is their go-to choice. It offers a fantastic blend of broad functionality and user-friendly design. The setup process is identical in principle to MetaMask. Create a wallet and guard that secret recovery phrase with your life. But what about blockchains that aren't compatible with Ethereum's technology? This is a key point many beginners miss. Not all crypto runs on the same rails. One of the biggest alternative ecosystems is Solana, known for its incredible speed and super low transaction fees. And the undisputed king of Solana wallets is Phantom. Phantom is to Solana what MetaMask is to Ethereum. It offers a beautifully designed, user-friendly experience as both a browser extension and a mobile app. If you want to interact with the vibrant NFT scene on Solana, or use its fast-growing DeFi applications, you need a Phantom wallet. The experience is slick. Transactions confirm in seconds, not minutes, and often cost fractions of a penny. Using Phantom was a revelation for many people who were used to the sometimes high fees and slower speeds of Ethereum. It operates on the same principles of self-custody. You control your keys, you are responsible for your seed phrase. Phantom simply provides the beautiful, secure interface for you to interact with the Solana blockchain. Having both MetaMask and Phantom is very common for active crypto users, as it gives them access to the two largest and most active smart contract ecosystems. So we have MetaMask for the Ethereum universe, Trust Wallet as a mobile-first multi-chain champion, and Phantom for the high-speed world of Solana. These apps are your keys to the kingdom. They allow you to move beyond simply investing in an asset and start using it within its native digital economy. You can lend your assets to earn interest, provide liquidity to decentralized exchanges to earn trading fees, or purchase digital art that you truly, provably own. But this is the frontier. And the frontier is filled with risks. Scammers are everywhere. They create fake websites that look identical to real ones to trick you into connecting your wallet and signing a malicious transaction. They send you free NFTs that, when you interact with them, contain code that can drain your funds. They will impersonate support staff in Discord servers and ask for your seed phrase to fix a problem. You must operate with a healthy dose of paranoia. Verify everything. Click nothing you don't trust. And understand that in the world of self-custody, you are the final line of defense. There is no one else. So, you have the centralized exchanges, simple, secure, but restrictive. And you have the self-custodial wallets, powerful, open, but demanding total personal responsibility. For a while, those were the only two options. But what if you're not ready to be your own bank just yet? What if you want the high interest rates people talk about in DeFi, but with the ease of use and perceived safety of a traditional financial app? Well, a new breed of company saw this gap in the market. They created platforms that look and feel like simple investment apps, promising to take your crypto and generate incredible returns for you. Sometimes upwards of 10, 15, or even 20% a year. They offered the best of both worlds. High yield with low effort. But as thousands of investors would soon discover in the most painful way imaginable, that convenience came with a very, very different, and perhaps even greater set of risks. That risk had a name. It was called counterparty risk. But to the millions of users who flocked to platforms like Celsius, Voyager, and BlockFi, it was simply called trust. They trusted the charismatic founders who went on YouTube every week, promising to unbank the world. They trusted the slick, user-friendly apps that looked and felt just like a modern online bank account. And most importantly, they trusted the promise that their crypto was safe, that it was theirs, and that it was earning a yield that traditional finance could only dream of. The model seemed so simple, so brilliant. You deposit your Bitcoin or Ethereum onto their platform. They then lend it out to institutional borrowers, big trading firms, hedge funds, and market makers, who are willing to pay a high interest rate for the liquidity. The platform takes a small cut and passes the lion's share of that interest back to you. It was pitched as a win-win. You, the little guy, finally get to participate in the kind of high-level financial maneuvering that was once reserved for Wall Street elites. But underneath this simple, elegant facade was a labyrinth of interconnected bets and daisy-chained loans, all built on a foundation of extreme risk. What most users didn't understand, because it was buried deep in the terms of service that nobody reads, was a single terrifying legal reality. The moment you deposited your crypto onto these platforms, it was no longer legally yours. You were no longer the owner of your assets. You were an unsecured creditor. You had given the platform an interest-free loan, and in return they gave you an IOU. And what were they doing with your crypto? They weren't just lending it out to reputable firms with full collateral. To generate those eye-watering yields of 8, 10, even 18%, they had to take bigger and bigger risks. They were lending out customer funds to other crypto firms with little or no collateral. They were engaging in a practice called rehypothecation, which is a fancy way of saying they were taking the assets you lent them, and then using those same assets as collateral to take out their own loans, leveraging up their bets. It was like giving your car to a valet who then uses your car's title to get a loan for himself. It's a house of cards, and all it needs is one strong gust of wind to come tumbling down. In May of 2022, that gust of wind arrived. And it wasn't a gust, it was a Category 5 hurricane named Terra Luna. To understand the great crypto collapse, you have to understand Terra. It was a multi-billion-dollar ecosystem built around an algorithmic stablecoin called UST. Now, a normal stablecoin like USDC or Tether is backed by real-world assets. For every one digital dollar they issue, they're supposed to have one real dollar, or a dollar equivalent, sitting in a bank account. It's a simple one-to-one peg. UST was different. It didn't have a vault of dollars behind it. Its stability was supposedly maintained by a complex algorithm, and its relationship with the sister token called Luna. The mechanics are complicated, but the promise was simple. One UST would always be worth $1, redeemable through a clever mint and burn mechanism with Luna. For a while it worked. The ecosystem exploded primarily because of a lending protocol called Anchor that was offering a staggering and completely unsustainable 20% yield on UST deposits. Traders, hedge funds, and even these big lending platforms like Celsius saw that 20% yield and couldn't resist. They poured hundreds of millions, even billions, of their customers' money into this experimental, unproven algorithmic stablecoin to capture that yield. They were chasing returns, and in the process, they exposed their entire user base to an unprecedented systemic risk. Then the unthinkable happened. The peg broke. In early May, a series of massive withdrawals from the Anchor protocol put immense pressure on UST. It slipped from $1 to 99 cents, then 98. The algorithm that was supposed to defend the peg kicked into high gear, minting trillions of new Luna tokens to try and absorb the selling pressure of UST. But instead of stabilizing it, this just created a death spiral. As more Luna was printed, its value plummeted, which in turn caused even more panic and loss of faith in UST's ability to ever recover its peg. Within 48 hours, a $40 billion ecosystem evaporated into thin air. UST, the stablecoin, fell to less than a penny. Luna, which had been trading at over $80 a coin just a month earlier, fell so low that its price was effectively zero. It was one of the single greatest destructions of wealth in a single week in modern history. And this is where the house of cards began to fall. One of the biggest players in the crypto space was a massive hedge fund called Three Arrows Capital, or 3AC. They were seen as the smartest guys in the room, managing billions of dollars and investing across the crypto landscape. It turns out they had a massive, undisclosed, and heavily leveraged position in Luna. When it went to zero, they were instantly wiped out. But 3AC didn't just lose their own money. They had borrowed astronomical sums from nearly every major lender in the space. And who were the biggest lenders to 3AC? You guessed it. Platforms like Voyager and BlockFi. They had lent hundreds of millions of dollars of their customers' money to 3AC, often with little to no collateral. Because hey, they were Three Arrows Capital, the smartest guys in the room. What could possibly go wrong? When 3AC went bust, they defaulted on those loans. That money was gone. Forever. Suddenly, the lending platforms had a gigantic, smoldering hole in their balance sheets where their customers' money used to be. The panic started immediately. People saw the Luna collapse and got scared. They rushed to the apps Celsius, Voyager to withdraw their funds to get their Bitcoin and Ethereum back into the safety of their own wallets. A classic bank run had begun. But these weren't banks. They didn't have FDIC insurance. And more importantly, they didn't have the money. It wasn't sitting in a vault. It was gone. It had been lent to 3AC. It had been gambled on experimental protocols. It had vanished in the Luna death spiral. On June 12, 2022, Celsius users woke up to a chilling notification. The company was pausing all withdrawals, swaps, and transfers between accounts. The gates were locked. Your money was trapped inside. 1 month later, they filed for Chapter 11 bankruptcy. The court filings revealed a $1.2 billion hole in their balance sheet. 1.7 million users had their life savings frozen, with no idea if they would ever see a single cent of it again. Just days after Celsius, Voyager Digital did the same. They froze withdrawals and then filed for bankruptcy. Their filings showed they had over $3.5 billion in customer assets on the platform, and they had loaned over $650 million of it to Three Arrows Capital, a loan that was now worthless. The stories that came out were heartbreaking. People who had put their entire life savings on these platforms, believing they were safe. People saving for a down payment on a house, for their kids' college tuition, for their retirement. All of it gone, vaporized by the reckless gambling of companies they were told to trust. They weren't sophisticated institutional investors. They were teachers, plumbers, nurses, and students who were sold a dream of financial freedom, only to be left holding an empty bag. This catastrophic failure exposed the fundamental difference between holding crypto on a centralized platform and holding it yourself. It was the most painful lesson imaginable in the oldest rule of Bitcoin. Not your keys, not your coins. If you don't control the private keys to your crypto, you don't actually own it. You own a promise from a company. And as millions of people discovered, when that company goes bankrupt, their promises are worth less than the pixels they were written on. The courts treat you not as an owner whose property was misplaced, but as a creditor, standing in a very, very long line with all the other creditors, hoping to get pennies on the dollar years down the road. These platforms weren't an evolution of banking. They were unregulated, uninsured shadow banks playing high-stakes poker with your money, and when the bet went bad, it was the customers who paid the ultimate price. This event forced a brutal but necessary reckoning in the industry. It drew a thick, bright line in the sand, separating the world of self-custody and decentralized finance from the world of centralized entities that masquerade as your friend while holding all the power. And it's this distinction that we must understand before we even think about downloading another app. So let's start with the king, the 800-pound gorilla that, for millions of Americans, is the crypto market. I'm talking about Coinbase. If you've ever talked to a friend or family member who got into crypto, there's a 90% chance their journey started on that clean, friendly blue and white app. And there's a reason for that. Coinbase solved the single biggest problem crypto had for its first decade. It wasn't scary anymore. Before Coinbase, buying Bitcoin felt like a back-alley deal on the dark web. It involved sketchy websites, complicated software, and a very real feeling that you were about to send your money into a black hole. Coinbase changed the game by making the experience feel boring. And I mean that as the highest compliment. They made buying a revolutionary, decentralized, world-changing asset feel as mundane as buying a book on Amazon or a stock through your Charles Schwab account. You link your bank account, you press a button that says buy, and boom, you own Bitcoin, or Ethereum, or one of the dozens of other assets they've handpicked for you. It's simple, it's intuitive, and most importantly for the American market, it feels safe. Coinbase is a publicly traded company on the NASDAQ. It's based in the United States. They talk about security, compliance, and regulation. Your US dollar deposits are even FDIC insured up to $250,000, just like a regular bank. It's the perfect Trojan horse. It looks and feels like the traditional financial world you're used to, but it's smuggling this wild, disruptive technology right onto your phone. For millions, this is the perfect entry point. It's a trusted guide in a dark forest. But this is where we have to remember the distinction we just talked about. Coinbase is a centralized entity. They are a bank for your crypto. And that convenience, that feeling of safety, comes at a cost. The first and most obvious cost is the fees. Using the simple buy and sell buttons on the main Coinbase app is brutally expensive. They charge a spread, which is a small margin built into the price you see, and a separate Coinbase fee. For a small purchase, say $50, you could easily lose $3 or $4 right off the top. It's a convenience tax, and it's a steep one. They are banking on the fact that you'll pay for simplicity. But the real cost isn't measured in dollars. It's measured in control. When you buy Bitcoin on Coinbase and leave it there, you don't actually hold the Bitcoin. You hold an IOU from Coinbase for that Bitcoin. They hold the all-important private keys in their massive institutional cold storage vaults. This is the origin of the most important phrase in all of crypto. Not your keys, not your coins. If Coinbase decides to freeze your account for any reason, your crypto is gone. If they go bankrupt, you become a creditor in a long, complicated legal proceeding, hoping to get a fraction of your assets back. If the US government decides to issue an order to seize assets, Coinbase, as a regulated US company, has to comply. You have traded the sovereignty and censorship resistance that makes crypto special for the convenience of a slick user interface. And then there are the outages. Ask anyone who was around for the 2017 or 2021 bull runs. When the market is going absolutely parabolic, when Bitcoin is hitting a new all-time high and the entire world is trying to log on at once to either buy in or sell the top, the app goes down. The website crashes. You're left staring at an error message, completely powerless, while the market moves violently without you. It's the ultimate reminder that you are not using a decentralized network. You are using a private company's server, and that server can and will fail you when you need it most. Now, before you delete the app, there is a secret that most beginners don't know. Inside your Coinbase account, there is a magic button. It's called Coinbase Advanced. It used to be a separate app called Coinbase Pro, but they've since integrated it. Toggling this on transforms the app from a simple, expensive tool into a sophisticated and dramatically cheaper trading platform. The fees on Coinbase Advanced are a tiny fraction of what you pay on the simple version. We're talking about a difference between paying $3 on a $50 trade versus paying maybe 30 cents. It's the exact same company, the same security, the same account, but they essentially hide the cheaper option behind a slightly more complex interface, knowing most people won't bother to look. If you use Coinbase, finding and using Coinbase Advanced is the single most important thing you can do to save money. But Coinbase isn't the only game in town. There's another US-based giant that has been around even longer, one that is often favored by more seasoned crypto veterans: Kraken. Founded in 2011, Kraken has built a reputation on two things: security and a crypto-first ethos. While Coinbase often feels like a tech company that happens to be in crypto, Kraken feels like it was built by crypto people from the ground up. They've never been hacked, a remarkable feat in an industry littered with exchange failures. They were one of the first exchanges to pioneer a concept called proof of reserves, where they hire independent auditors to come in and cryptographically prove that they actually hold all of the customer assets they claim to. It's a level of transparency designed to build trust not through marketing, but through verifiable proof. Kraken's platform, especially Kraken Pro, is a dream for anyone who wants to get more serious. The fees are highly competitive, often even lower than Coinbase Advanced. They offer a wider selection of digital assets, including many smaller, more obscure coins that Coinbase wouldn't touch. And for advanced users, they offer more sophisticated tools like margin trading and futures, allowing you to bet on the future price of crypto. Though these are incredibly risky tools that beginners should absolutely stay away from. The trade-off? Kraken's interface isn't quite as polished or hand-holding as the basic Coinbase experience. It assumes a little more knowledge from its users. It feels less like a friendly neighborhood bank and more like a professional trading desk. For some, that's a bug. For others, it's a feature. It's a platform that respects its users enough to give them powerful tools and expects them to learn how to use them. They treat you less like a customer and more like a trader. So when we look at these two titans of the American crypto landscape, Coinbase and Kraken, we see two sides of the same centralized coin. They are the gatekeepers. They are the bridges connecting the old world of dollars and bank accounts to the new world of digital assets. They both offer a similar product, but with a different philosophy. Coinbase offers unparalleled simplicity and a user-friendly on-ramp, but at the cost of high fees and the illusion of control. Kraken offers a more robust, secure, and feature-rich platform, demanding a bit more from its users but rewarding them with lower fees and a greater sense of transparency. Choosing between them is about understanding your own priorities. Are you willing to pay a premium for an experience that feels as easy as Venmo? Or do you want a more powerful, cost-effective tool, even if it has a slightly steeper learning curve? Both are fantastic, regulated, and relatively safe places to begin your journey and make your first purchase. But they are just that, the beginning. They are the lobby to a much larger, more complex, and infinitely more interesting building. And the most popular crypto app in America might not even be one of these dedicated exchanges. It might be one you already have on your phone right now. I'm talking about apps like Robinhood, Webull, PayPal, and Cash App. These platforms are the titans of modern finance, the slick, gamified gateways that brought stock market investing to millions of millennials and Gen Z. And when they saw the crypto gold rush, they knew they had to get in on the action. Their approach was genius in its simplicity. Just add a crypto tab. Make buying Bitcoin as easy as buying a share of Tesla. No new app to download, no complicated sign-up. No weird jargon about wallets or private keys. Just use the account you already have, link your bank and tap buy. And for millions of Americans, this was their first taste of crypto. It was frictionless. It was familiar. Felt safe. Robinhood, in particular, led the charge. They stripped away all the complexity. The charts were simple, the execution was instant, and suddenly you were a crypto investor. You could watch the price of Dogecoin go to the moon right next to your GameStop stock. It was the perfect bite-sized entry point. The appeal is undeniable. If you just want to speculate on the price, if you believe Bitcoin is going up and you want to profit from that movement without any of the technical hassle, these apps are fantastic. They are the path of least resistance. But there's a fundamental, earth-shattering difference between buying Bitcoin on Robinhood and buying it on an exchange like Coinbase or Kraken. And it's a difference these apps weren't exactly shouting from the rooftops. For the longest time, when you bought crypto on Robinhood, you didn't actually own the crypto. You owned an IOU, a promise from Robinhood that they were holding a certain amount of Bitcoin on your behalf. Think of it this way. It's like going to a gold dealer. You give them $1,000, and they give you a beautiful laminated certificate that says, you own $1,000 worth of gold. The price of your certificate goes up and down with the price of gold. You can sell it back to the dealer at any time, but you can't take the gold home. You can't put it in your own safe. You can't melt it down to make jewelry. You can't give a gold coin to your grandchild. You don't have the gold. You have a tracker, a synthetic representation of the asset, held entirely within the dealer's vault, under their rules. That was Robinhood crypto for years. You couldn't withdraw your Bitcoin to your own wallet. You couldn't send it to a friend. You couldn't use it to buy a coffee or a Tesla. You couldn't participate in the vast, exciting world of decentralized finance. All you could do was buy it, hold it, and sell it, all within Robinhood's walled garden. You were betting on the price, but you weren't participating in the network. This is the great trade-off. In exchange for ultimate convenience, you gave up the single most revolutionary aspect of cryptocurrency: ownership, control, self-sovereignty. The mantra you'll hear over and over in the crypto world is, not your keys, not your coins. If you don't control the private keys, the secret password that proves ownership of crypto on the blockchain, you are trusting a third party to be your custodian. You are trusting the very kind of institution that Bitcoin was designed to make obsolete. Now, to be fair, the landscape is changing. Under immense pressure from users who grew wise to this limitation, Robinhood has slowly, painstakingly begun rolling out actual crypto wallets. They've started allowing users in certain regions to withdraw their crypto to external wallets. It's a massive step in the right direction, an admission that their initial model was flawed, but it also turned their platform into a hybrid. You have to specifically sign up and get approved for their Web3 wallet to get these features, and for millions of their legacy users, the old U system remains the default. The convenience is still king, and the true nature of ownership is still an afterthought. Then you have Webull, often seen as Robinhood's slightly more sophisticated competitor. It offers more advanced charting tools, more data, and appeals to a crowd that wants to feel a bit more like a real trader. But when it comes to crypto, they followed the exact same playbook. For the longest time, it was a closed loop. Buy, hold, sell. No deposits, no withdrawals. It was the same walled garden, just with more technical-looking wallpaper. Like Robinhood, they've also begun to slowly introduce wallet functionality, but the core product was built on the idea of crypto as a stock, a simple ticker symbol to be traded, not an asset to be owned and used. But then the story gets more interesting with apps that came from a different world. The world of payments. I'm talking about Cash App and PayPal. Cash App, owned by Block, the company run by Bitcoin evangelist Jack Dorsey, was one of the earliest and easiest ways for a normal person to buy Bitcoin. Their interface made it ridiculously simple, but they made one monumentally important design choice that set them apart from Robinhood. From day one, they allowed you to withdraw your Bitcoin. They understood the assignment. They knew that true ownership was the entire point. You could buy Bitcoin in seconds and then, with a few more taps, send it to your own secure hardware wallet, becoming your own bank. For this reason, Cash App is held in much higher regard by crypto purists than almost any other mainstream finance app. PayPal, on the other hand, stumbled into the same trap as Robinhood. When the payments giant finally turned on crypto purchasing for its 400 million users, it was a watershed moment for adoption. A Buy Bitcoin button appeared in an app that people trusted with their money for decades. The problem? It was a fortress. Once you bought crypto on PayPal, it was stuck there. You couldn't move it. You were completely at the mercy of their platform, their fees, and their rules. It was the ultimate Hotel California of crypto. You could check out anytime you like by selling back to dollars, but you could never leave with your coins. Again, after facing backlash and seeing the writing on the wall, PayPal has since enabled withdrawals. But the initial design reveals the mindset of these large, traditional finance companies. Their instinct is to control the asset, to keep you in their ecosystem, to treat crypto just like any other number in their database. So what we have are two fundamentally different philosophies clashing within the apps on your phone. On one side, you have the dedicated crypto exchanges like Coinbase, which were built from the ground up on the principle of crypto as a new kind of property, something you can hold, control, and use. On the other side, you have the traditional finance apps like Robinhood and PayPal, who saw crypto as just another speculative asset to be traded like a stock or a commodity. They bolted it onto their existing infrastructure, and in doing so, they stripped it of its soul. They sold the sizzle, but they forgot the steak. They gave people price exposure, but they denied them ownership. This is the critical distinction a new investor has to understand. These all-in-one apps are not a scam. They are a legitimate, and for many, a very reasonable first step. They are the training wheels. They let you get a feel for the market, to experience the volatility, to put a little skin in the game without the fear of losing a private key or sending Bitcoin to the wrong address. But they are not the end game. They are a shallow version of a deep technology. Using them is like saying you're a car enthusiast because you play a racing video game. You're interacting with a simulation of the real thing. And this begs a giant looming question. So what? Why does it matter? If all I want to do is make money when the price goes up, who cares if I have the real Bitcoin or just a Robinhood out? Why should I bother with the complexity of wallets and keys and all that other nonsense? It sounds like a lot of risk and a lot of work for no real reason. And that, right there, is the billion-dollar question. And the answer reveals the entire difference between a speculator and an investor, between a tourist and a citizen of this new digital nation. The answer is the reason people are willing to risk everything for this technology. The answer is control. It's the belief that the financial system we were all born into is fundamentally broken. A system where governments can print money into oblivion, devaluing your savings without your consent. A system where giant faceless banks act as gatekeepers, deciding who gets a loan, who can send money, and charging exorbitant fees for the privilege. Crypto at its core isn't just a new asset class. It's a parallel financial system being built from the ground up. A system with no central authority, no CEO, and no headquarters to shut down. A system where you and you alone are in complete control of your wealth. It's the difference between renting an apartment and owning your own land. That is why people are willing to risk it all. It's a vote with their dollars for a different future. And the first vote you cast is choosing where you buy in. The app you choose isn't just a tool. It's a statement about what kind of participant you want to be. Are you a tourist here to just watch the sights and maybe buy a souvenir? Or are you a citizen, ready to own a piece of this new digital world? This distinction is everything, and it's reflected in the very architecture of the apps we're about to explore. Let's start with the tourist traps. I say that with some affection because they serve a purpose. These are the apps that make it incredibly easy to get exposure to crypto's price. Think Robinhood, Webull, PayPal, even Cash App. Their genius is in their simplicity. If you already have an account to buy stocks, you're literally 2 taps away from owning Bitcoin or Ethereum. The user interface is clean, familiar, and non-threatening. For millions of people, this was their first ever crypto purchase. And that's a good thing. It lowers the barrier to entry. But here's the critical catch, the secret they don't advertise on the homepage. On most of these platforms, you don't actually own the crypto. You own an IOU from the company. You're making a bet on the price, but you don't hold the underlying asset. You can't send that Bitcoin to a friend. You can't use that Ethereum to interact with a decentralized application. And most importantly, you cannot withdraw it to a wallet that you control. This brings us to the most important mantra in this entire space. Not your keys, not your coins. If you don't control the private keys, the complex password that proves ownership on the blockchain, you are trusting a third party to hold your assets for you. You've simply traded a bank for a tech company. For the tourist who just wants to speculate on the price, maybe that's fine. But for the citizen, it misses the entire point. To become a citizen, you need to go to a proper port of entry. In the crypto world, these are the dedicated cryptocurrency exchanges. These are the platforms built from the ground up for buying, selling, and crucially withdrawing real on-chain crypto assets. In the United States, there are three titans that dominate this landscape for new users: Coinbase, Kraken, and Gemini. Choosing between them is like choosing between an iPhone, a high-end Android, and a military-grade satellite phone. They all do the same core job, but their philosophy and user experience are vastly different. Let's start with the undisputed king of simplicity, Coinbase. If crypto had an Apple, it would be Coinbase. It's the platform your parents have heard of. It's a publicly traded company on the NASDAQ, which gives it a veneer of legitimacy and regulatory safety that others lack. The user experience is beautiful, intuitive, and designed to hold your hand every step of the way. Buying your first fraction of a Bitcoin on Coinbase feels as easy as ordering a pizza. But just like Apple, that simplicity and premium experience comes at a cost. The fees on the standard Coinbase app can be surprisingly high, especially for smaller, frequent trades. They bake their fee into the spread, the difference between the buy and sell price, and add a transaction fee on top. It's the price you pay for convenience. However, here's a pro tip that can save you a fortune. Coinbase has a second, less advertised platform for active traders, now called Advanced Trade. It used to be a separate app called Coinbase Pro. It's the same company, same login, same security, but with a much more complex interface and dramatically lower fees. Learning to use Advanced Trade instead of the simple Blue app is one of the single best ways to save money as you get more serious about investing. Coinbase is the perfect gateway. Easy, secure, and publicly accountable. It's the citizen's starting point. Next, we have Kraken. If Coinbase is the shiny new iPhone, Kraken is the battle-tested, infinitely customizable Android. Kraken is one of the oldest and most respected exchanges in the world, founded way back in 2011. They've never been hacked, a claim very few exchanges can make, and their reputation for security is legendary. Their focus isn't on a beautiful, minimalist design. It's on functionality, low fees, and security. The interface can feel a bit more cluttered to a brand new user, but the trade-off is worth it. Their fees are significantly lower than standard Coinbase, and they have a reputation for incredible customer support, which is a rarity in the crypto space. Kraken feels like it was built by crypto purists for crypto purists. It's a platform that respects its users' intelligence and provides them with powerful tools without the hefty price tag. For the user who is willing to spend an extra hour learning the ropes to get better security and lower fees, Kraken is arguably the best choice in the United States. Then there's Gemini. Founded by the Winklevoss twins, yes, the ones from the Facebook movie, Gemini's entire brand is built around one word: regulation. They position themselves as the safe, regulated crypto exchange, the one that institutions and Wall Street types could trust. They go above and beyond to comply with New York's stringent bit license regulations, often seen as the toughest in the country. Their platform is clean, their security is top-notch, and they offer a curated, smaller selection of well-vetted cryptocurrencies. For a while, they were the gold standard for trust. However, their flagship Gemini Earn program, which offered users interest on their crypto, blew up spectacularly when their partner, Genesis, went bankrupt, freezing hundreds of thousands of customers' funds. This serves as a brutal reminder that even on the most regulated platforms, risk is ever present. Trust but verify. Gemini is still a solid, secure exchange for buying and selling, but its story is a cautionary tale about the dangers of chasing yield and trusting third parties, no matter how regulated they claim to be. So you have the simple choice Coinbase, the powerful choice Kraken, and the regulated choice Gemini. But what if you want to venture further out? What if you hear about a small, obscure coin that isn't listed on these major US exchanges? This leads you to the Wild West, the US-based arms of global exchanges. The two biggest names here are Binance US and KuCoin. First, let's be crystal clear. Binance.com is the largest crypto exchange in the world. It is a behemoth. However, it is not licensed to operate in the United States. To serve American customers, they created a separate, stripped-down, and legally distinct entity called Binance.US. While it carries the powerful brand name, it is a shadow of its global counterpart. It has a fraction of the coins listed and a fraction of the trading volume. Its main allure is its rock-bottom fees, which are often the lowest in the industry. But it exists in a state of constant regulatory uncertainty, facing lawsuits and pressure from US agencies. Using Binance.us can feel like you're getting a great deal, but you're also accepting a higher level of platform risk. KuCoin is another popular choice for those hunting for rare crypto gems. It's a global exchange that, for a long time, allowed U.S. customers to trade without the strict identity verification required by Coinbase or Kraken. This made it a haven for altcoin traders. However, the regulatory walls are closing in, and their policies for U.S. users are becoming more restrictive. These platforms are for the advanced user, the citizen who has graduated from the main city and wants to explore the frontier. The potential rewards are higher. You might find the next big thing before it lists on Coinbase, but the risks are exponentially greater. You're dealing with less regulatory oversight, less transparency, and often less recourse if something goes wrong. Choosing your exchange is like choosing the port you sail from. You can choose the heavily guarded, well-lit commercial port of Coinbase, the industrious and efficient naval base of Kraken, or the high-risk, high-reward smuggler's cove of a global platform. But once you've bought your crypto, you've left the shore. You're on the open sea. And out there, you are your own bank and your own security. The question is no longer where to buy, but how to hold it, how to truly own it. And that is where the real revolution begins. And that revolution starts with a simple yet profound shift in thinking. You have to stop thinking like a customer of a bank and start thinking like the owner of one. The apps we've talked about, Coinbase, Kraken, Gemini, they are fantastic on-ramps. They are the ports where you exchange your dollars for this new digital cargo. But leaving your crypto on an exchange is like leaving your gold with the merchant who sold it to you. You're trusting them to keep it safe. You're trusting them not to go bankrupt. You're trusting them not to get hacked. And while these are reputable, regulated companies, the core principle of cryptocurrency, the very soul of this technology, is self-sovereignty. The idea that you and you alone can hold and control your assets without needing permission from any third party. To do this, you need a wallet. Not a leather wallet for your cash, but a digital wallet for your crypto. This is where the magic happens. A crypto wallet doesn't actually store your coins like a piggy bank. Your crypto, your Bitcoin, your Ethereum, it never leaves the blockchain. The blockchain is a global public ledger, remember? Your coins are just entries on that ledger. What your wallet stores are your keys, specifically your private keys. This is the most important concept you need to grasp to truly understand crypto. Every wallet has two types of keys, a public key and a private key. Think of it like a high-tech mailbox. Your public key is your mailing address. You can give it to anyone in the world. People can use that address to send you crypto just like they'd send you a letter. It's completely safe to share. Your private key, however, is the physical key that unlocks your mailbox. It's the only thing that allows you to open the box and access what's inside. Proves that you are the owner. If you lose that key, you can never open the mailbox again. And if someone else gets a copy of your key, they can open your mailbox and take everything. Your private key is everything. It is the literal ownership of your crypto. And the phrase you will hear repeated like a mantra in this space is, not your keys, not your crypto. If your assets are sitting on an exchange, you don't hold the private keys. The exchange does. You just have an IOU. When you move your assets to your own wallet, you are taking possession of those private keys. You are becoming your own bank. So what kind of wallets are there? They fall into two major categories, hot wallets and cold wallets. Let's start with hot wallets. The name is simple. They are hot because they are connected to the internet. These are software programs you can install on your computer as a browser extension or on your phone as an app. Think of a hot wallet as the wallet you carry in your pocket every day. It's convenient, easy to access, and perfect for holding small amounts of cash you plan to spend. The most famous hot wallet, the undisputed king of the space, is MetaMask. If you've ever seen a little fox icon in someone's browser, that's it. MetaMask is the primary gateway to the world of Ethereum and its vast ecosystem of decentralized applications, or dApps. It allows you to not just hold your crypto, but to interact with it, to lend it, borrow, swap it, and use it in thousands of ways, which we'll touch on later. It's the passport to the decentralized web. Another major player, especially if you're interested in the Solana ecosystem, is Phantom. It's essentially the MetaMask of Solana, sleek, user-friendly, and your ticket to the fast-growing world of apps being built on that network. Then you have multi-chain wallets like Trust Wallet or Exodus. These are fantastic mobile and desktop apps that are designed to hold a huge variety of different cryptocurrencies, not just ones on a single network. They often have a beautiful user interface and make it very easy to view your entire portfolio in one place. The biggest advantage of a hot wallet is convenience. They are almost always free, they take minutes to set up, and they make transacting incredibly simple. The disadvantage? They are connected to the internet. This makes them inherently more vulnerable. If your computer gets a virus, or you accidentally click a malicious link in a phishing email that tricks you into connecting your wallet, a hacker could potentially drain your funds. This is why you follow the rule of the physical wallet. Never carry more in your hot wallet than you're willing to lose. It's for your walking around money, not your life savings. For your life savings, you need to go cold. Cold wallets, also known as hardware wallets, are the polar opposite. These are physical offline devices, usually resembling a USB stick, that store your private keys in a completely isolated environment. They are cold because they are never directly exposed to the internet. Think of a cold wallet not as the wallet in your pocket, but as a fortified safe buried in your backyard. It's the gold standard for security. When you want to make a transaction, you plug the device into your computer. The transaction details are sent to the hardware wallet. You verify them on the device's small screen, and you physically press a button on the device to approve it. The private key never, ever leaves that little piece of hardware. This means that even if your computer is riddled with viruses and spyware, a hacker cannot steal your crypto. They can't press the physical button on the device sitting on your desk. This physical security step is what makes them so incredibly powerful. The two titans in the hardware wallet space are Ledger and Trezor. They are the Coca-Cola and Pepsi of cold storage. Ledger, with its popular nano models, looks like a sleek foldable USB drive. Trezor has a slightly different design, often with a larger touchscreen for verifying transactions. Both are incredibly reputable and have been battle-tested for years. They do cost money, typically ranging from $60 to over $150, but if you are investing any significant amount into crypto, a hardware wallet isn't a luxury, it's an absolute necessity. It is the single best insurance policy you can buy for your digital assets. Now, whether you choose a hot wallet, a cold wallet, or both, you will be introduced to the single most important piece of information you will ever manage in your crypto journey. It's called your seed phrase or recovery phrase. When you first set up a new wallet, it will generate a unique list of 12 or 24 random words. This is your seed phrase. This phrase is the master key to all the private keys in your wallet. If your phone falls into a lake, or your computer dies, or your hardware wallet gets run over by a truck, you can simply download the same wallet software on a new device, or buy a new hardware wallet, enter your 12 or 24-word seed phrase, and poof, your entire portfolio is instantly restored. This is incredible power, but it comes with terrifying responsibility. Because this works for you, but it also works for anyone else who gets their hands on it. If someone finds your seed phrase, they can steal every last cent you own. And there is no bank to call, no transaction to reverse, no customer service to help you. It will be gone forever. So listen very carefully. You must write your seed phrase down on a piece of paper, or better yet, stamp it into a piece of metal. You then store it in a secure secret offline location. Or better yet, 2 secure secret offline locations. You never ever store it digitally. Do not take a screenshot of it. Do not save it in a text file on your computer. Do not email it to yourself or save it in your cloud drive. Any digital storage is a target for hackers. You treat those 12 or 24 words like they are bearer bonds to your entire digital net worth. Because that's exactly what they are. Most serious investors use a combination of wallets. They keep a large portion of their holdings, their long-term investments, tucked away safely on a hardware wallet. Then they'll keep a smaller, disposable amount on a hot wallet like MetaMask for interacting with apps, buying NFTs, or making quick trades. It's the best of both worlds. Ultimate security for the vault, and convenient access for daily use. By taking this step, by moving your assets from an exchange to a wallet where you control the keys, you fundamentally change your relationship with your money. You are no longer just an investor. You are a participant. You are a citizen of this new digital nation. Now that you have the keys to your own bank, the real question becomes, what can you do inside? The journey doesn't end with just holding. In fact, that's where it truly begins. The apps we've discussed are just the storefronts. The real digital economy, the world of decentralized finance, exists just beyond them. And to access it, you need to know which key unlocks which door. That key isn't an app on your phone, not in the same way Coinbase or Kraken are. That key is something you, and only you, control. It's called a non-custodial wallet, or a self-custody wallet. This is the single most important concept to grasp if you want to move beyond just buying and selling. On an exchange like Binance US, they are the custodian. They hold your crypto for you. It's like putting your money in a bank. You have a claim to it, but the bank holds the vault. A self-custody wallet is you owning the vault, the key, the security system, and the land it sits on. The most famous phrase in all of crypto is, "Not your keys, not your crypto." This is what it means. When you create a self-custody wallet, you are given a secret recovery phrase, usually 12 or 24 words in a specific order. This phrase is everything. It is the master key to your funds. Anyone who has it can access your crypto from anywhere in the world. You must write it down on paper and store it in multiple secure offline locations. Never store it as a screenshot on your phone. Never save it in a text file on your computer. Never, ever, ever give it to anyone who asks for it online. No support team will ever need it. It is for your eyes only. This responsibility is terrifying, but it is also the foundation of true digital ownership. So what are these wallets? The undisputed king of the castle, the gateway for millions, is MetaMask. That little fox icon you might have seen. MetaMask lives as a browser extension and a mobile app, and it acts as your passport to the decentralized web, specifically the world built on Ethereum and other compatible networks. It lets you sign transactions, interact with applications, and manage your assets, all without a central intermediary. For those who prefer a mobile-first experience or want to explore a wider variety of blockchains right out of the box, there's Trust Wallet. And if you're diving into the fast-growing Solana ecosystem, the go-to wallet is Phantom. Each of these wallets serves the same core purpose. They put you in control. They are the keys. Now for the doors. What are we unlocking? We are unlocking the world of decentralized finance, or DeFi. Imagine all the services a bank offers. Earning interest, taking out loans, exchanging currencies, buying insurance. Now imagine all of that rebuilt with code on a blockchain, open 24/7, accessible to anyone with an internet connection with no central company calling the shots. That's the promise of DeFi. Let's get specific. You've bought some Ethereum on Kraken. It's sitting there, maybe going up in value, maybe going down. But it's passive. What if you could put it to work? You could withdraw that Ethereum from Kraken to your new MetaMask wallet. The process is simple but requires extreme care. You copy your wallet address from MetaMask, paste it into the withdrawal field on Kraken, select the correct network. This is critical. Sending on the wrong network can mean your funds are lost forever. Double and triple check the address and send. After a few minutes, that Ethereum is no longer in Kraken's vault. It's in yours. Now the fun begins. You can go to a decentralized lending protocol like Aave. Here you can deposit your Ethereum into a lending pool. In return, you start earning interest paid out in real time, block by block. Other people can then borrow from that pool, providing their own crypto as collateral. You've just become a lender in a global, autonomous financial system. No paperwork, no credit check, just code. Or maybe you want to trade a new, up-and-coming token that isn't listed on major exchanges yet. You can go to a decentralized exchange or DEX like Uniswap. Unlike Coinbase, which uses a central order book to match buyers and sellers, Uniswap uses something called a liquidity pool. Users, people like you and me, can deposit pairs of tokens like Ethereum and a stablecoin like USDC into a pool. This provides the liquidity for others to trade against. In return for providing this service, you earn a tiny fraction of every single trade that happens in that pool. This is called liquidity providing, or yield farming, and it's one of the core activities in DeFi. This is a universe of money Legos, where different protocols can be plugged into each other to create new financial strategies. You could take the interest-bearing tokens you get from lending on Aave, and then use those as collateral on another platform to do something else entirely. The possibilities are dizzying, and frankly, so are the risks. This is not the safe, regulated, FDIC-insured world of traditional finance. This is the Wild West, and you are your own sheriff. The biggest risk is smart contract risk. Every DeFi application is powered by code, a smart contract. If there is a bug or a vulnerability in that code, hackers can exploit it and drain the protocol of all its funds. It has happened many times, resulting in hundreds of millions of dollars lost. You are placing your trust not in a company, but in the integrity of lines of code. Then there's the risk of impermanent loss when you're providing liquidity, a complex phenomenon where the value of your deposited assets can end up being less than if you had just held them in your wallet, due to price volatility. And of course, there are the scams. Sophisticated phishing attacks, fake websites that look identical to the real ones, designed to trick you into signing a transaction that drains your wallet. The vigilance required is an order of magnitude higher than when you're just using a centralized exchange. But the reward for navigating these risks is participation. You are no longer just a spectator buying a digital asset and hoping it goes up. You are an active participant in a new, parallel financial system. You are earning yield, providing liquidity, and helping to govern these protocols by voting with your tokens. You are, in a very real sense, becoming the bank. This transition from a centralized exchange user to a decentralized finance user is the most significant leap you can make in your crypto journey. It's the difference between buying a share of Apple stock and actually using Apple products to build your own business. The apps we first talked about, Coinbase, Gemini, Kraken, are the perfect on-ramps. They are the regulated, user-friendly bridges that connect our traditional financial system to this new digital frontier. They are where you convert your dollars into digital assets. But they are just the starting point. The true innovation, the reason so many brilliant minds are dedicating their lives to this space, isn't found in a centralized apps by button. It's found in the permissionless, open source, and user-owned world of DeFi. It's a world where your financial destiny is not determined by a board of directors or a government regulator, but by your own knowledge, your own risk tolerance, and the security of a 12-word phrase you keep hidden under your mattress. It's a world that demands more from you, but in return, offers you a level of financial sovereignty that has never existed before. The question now is, how do you build a coherent strategy to navigate both of these worlds, the centralized and the decentralized, safely and effectively over the long term? That strategy begins with a simple, powerful concept, the hybrid approach. You don't have to choose between the convenience of a centralized exchange and the sovereignty of a decentralized wallet. You should use both, but for very different purposes. Think of it as a tiered system for your digital assets, much like how you manage your traditional finances. Let's call this your personal security protocol. Tier 1 is your spending account. This is the small amount of crypto you keep on a trusted, insured, and highly regulated centralized exchange like Coinbase or Kraken. This is your on-ramp and off-ramp, the bridge where you convert your US dollars into crypto and back again. It's the crypto you might use for quick trades, for experimenting with new assets, or for sending to a friend. Just like the cash in your physical wallet, it's for convenience and daily use. You wouldn't walk around with your life savings in your back pocket, and you shouldn't keep it on an exchange either. This tier prioritizes accessibility over absolute security. Tier 2 is your checking account. This is for the assets you want to actively use within the crypto ecosystem. Once you've bought your crypto on a centralized exchange, you move a portion of it here to a self-custody software wallet or hot wallet, like MetaMask or Trust Wallet. This wallet holds the keys to your DeFi adventures. It's what you connect to decentralized exchanges, lending protocols, and NFT marketplaces. It's more secure than an exchange because you, and only you, hold the private keys. However, because it's software that's constantly connected to the internet, it's still considered hot and carries a small but real risk of being compromised through phishing attacks or malware. This tier is your gateway to participation, balancing security with functionality. Tier 3 is your savings vault. This is the most important tier, where the vast majority of your long-term holdings should live. This is your cold storage, most commonly a hardware wallet from a reputable brand like Ledger or Trezor. After you buy your Bitcoin or Ethereum on an exchange, and after you've set aside your spending and checking amounts, the rest, your core investment, gets transferred here. A hardware wallet keeps your private keys completely offline, isolated from the internet. To authorize any transaction, you need to physically press buttons on the device itself. This makes it virtually immune to remote hacking. This is your digital fortress. It's not for frequent trading. It's for securing your wealth for years, or even decades. This tier prioritizes maximum security above all else. By implementing this three-tiered system, you get the best of both worlds: the user-friendly experience of a centralized app for getting started, and the ironclad security of self-custody for protecting what you build. But having the right storage strategy is only half the battle. The other half is the investment strategy itself. How do you actually build a portfolio in one of the most volatile asset classes in human history? First, you must erase the idea of getting rich overnight. That's lottery ticket thinking, and it's the fastest way to get wrecked. The most sustainable, time-tested strategy for the average investor is dollar cost averaging, or DCA. It's painfully simple, which is why so many people ignore it in search of a more exciting secret. You simply invest a fixed amount of money at regular intervals, say $50 every Friday regardless of the price. When the price is high, your $50 buys you a little less crypto. When the price is low, that same $50 buys you a whole lot more. Over time, this smooths out the volatility and lowers your average cost basis. DCA removes emotion from the equation. It prevents you from panic selling at the bottom and FOMO buying at the top. It's a disciplined, automated approach that turns volatility from your enemy into your friend. Next, you need a framework for what to actually buy. A balanced portfolio is key. While not financial advice, a common model many investors consider is a variation of the 80-15-5 rule. 80% of your portfolio goes into the established, blue-chip cryptocurrencies. Right now, that's Bitcoin and Ethereum. They have the longest track records, the largest networks, the most security, and the highest levels of institutional adoption. They are the bedrock of the entire crypto market. Think of them as the S&P 500 of the digital asset world. They are your foundation. 15% can be allocated to promising large-cap altcoins. These are projects in the top 20 or top 50 by market capitalization that have strong development teams, unique use cases, and thriving communities. They carry more risk than Bitcoin and Ethereum, but also offer higher potential for growth. This is where you do your homework, reading white papers, understanding the technology, and betting on the protocols you believe will form the backbone of the next generation of the internet. Finally, a maximum of 5% can be your venture capital bucket. This is for highly speculative small-cap projects. These are your moonshots, the crypto equivalent of a seed-stage startup. The overwhelming majority of these will fail, going to zero, but the one or two that succeed could deliver astronomical returns. This portion of your portfolio must be money you are fully 100% prepared to lose. It's the high-risk, high-reward part of your strategy, and it should be treated like a trip to Vegas. Fun, exciting, but not the basis of your retirement plan. Underpinning all of this is the single most important principle in crypto: do your own research. The space is filled with noise, hype, and bad actors trying to sell you their bags. You have to become your own analyst. Don't trust, verify. Question everything. Learn to distinguish between a revolutionary technology and a clever marketing campaign. And that brings us to the final piece of the puzzle, the psychological game. Investing in crypto is a masterclass in emotional regulation. You will experience gut-wrenching downturns where your portfolio is down 50, 60, even 80%. The media will declare crypto debt for the 1000th time. Your friends and family will tell you, "I told you so." This is where fortunes are truly made or lost. You must understand that volatility is the price of admission. It's the cost you pay for the opportunity of outsized returns. If you can't stomach the drops, you don't deserve the gains. Your greatest defense against this psychological warfare is your strategy. When your dollar cost averaging, a price crash isn't a disaster. It's a discount. It's a sale on a world-changing asset class. When you have a long-term time horizon, you learn to stop checking the price every 5 minutes and instead zoom out. Look at the 4-year cycle. Look at the decade-long trend. The short term is a voting machine driven by fear and greed. The long term is a weighing machine, driven by fundamentals and adoption. Your two greatest enemies will be FOMO, the fear of missing out, which tempts you to buy the top of a parabolic rally, and FU, fear, uncertainty, and doubt, which tempts you to sell the bottom of a soul-crushing crash. A predefined plan, a tiered security setup, and a disciplined DCA schedule are your shield and armor against these emotional attacks. So as we bring this guide to a close, let's reflect on the journey. We started with the familiar interfaces of apps like Robinhood and Cash App, simple gateways into this new world. We graduated to the power and depth of dedicated exchanges like Coinbase and Kraken, the true marketplaces of the digital economy. And we finally arrived at the frontier of self-sovereignty, understanding the profound responsibility and freedom that comes with holding your own keys in a wallet like MetaMask, secured by a hardware device. We've learned that choosing an app isn't just about low fees or a slick design. It's about aligning the tool with your goals, your risk tolerance, and your place on the crypto learning curve. This isn't just an investment in a new asset class. It is an investment in a new paradigm. A paradigm of verifiable digital ownership, of transparent and open financial systems, and of individual empowerment. The path is not easy. It requires continuous learning, personal responsibility, and a conviction that can withstand extreme volatility. But the potential reward isn't just financial. It's the chance to be an early participant in one of the most significant technological revolutions since the internet. Your journey is just beginning. The real investment isn't just your capital. It's your time and your curiosity. Keep learning, stay humble, Think in decades, not days, and build your strategy with patience and discipline. The future of finance is being written in real time, in lines of code that span the globe. And with the right tools, the right knowledge, and the right mindset, you have the power to be one of its authors.